To keep yourself updated, subscribe to Indigo Learn and click the bell icon.
Friends, today we are going to discuss about the concept of depreciation. What is the concept of depreciation? Did you ever hear this word depreciation? Well, even if you have not heard the phrase or the word depreciation, I am sure the impact of depreciation you would have seen in your life. How? Say, we buy a new television at home. Now, the television after say 5 years or 6 years or 10 years, you will start noticing that the television is not the same as what it was when it was purchased, right? So, after usage, the worth of TV slowly goes down, gradually goes down, and there will be a point where television ultimately will become worthless. Correct or not? So, gradually, year on year, the value or the worth of television will go down because you are using it. Naturally, the worth of television will go down. Fine. Now, take another example. You purchase a new car. Now, when you buy a new car, fantastic, you are happy. But gradually, as you use the car, will the worth of the car go down? Yes, the worth of the car will go down. What if you decide not to use the car? You bought the car and you neatly kept it in your garage, just locked it. You didn't use the car. 5 years lapsed. What will happen? You take the car out. I doubt whether that car will even start. Why? Because the car was supposed to be used. Even if you don't use it, still there will be a reduction in the worth of the car because there is passage of time. There is passage of time means if say these many years are over, even if I don't use the car, still there will be some reduction in the value. Alright. Now, I am sure some of you who have been to coastal regions would have noticed, something called as corrosion. Now, what happens is in coastal regions, because of the salinity even in the wind and atmosphere generally, be it buildings or be it any iron rods, they get rusted faster. Now, why is that happening? Gradually over time, when this iron rod gets in touch with the salt and moisture, gradually this starts wearing off, and that is a natural process. So friends, this is another example of the value of an asset going down gradually. Say, we have an oil well. Oil well will have a definite amount of oil reserves in it. It could be oil well, it could be a granite quarry, or it could be an iron ore quarry or iron ore mine, whatever. So these natural resources have a definite and fixed amount of natural resource in them. So when you start taking out those resources, say the resource probably has some 10,000 metric tons of oil. I'm just giving an example, 10,000 metric tons of oil. I have already drawn 7,000 metric tons of oil. Then the balance of 3,000 metric tons only we can draw from that, rest we can't draw. So like that there will be a reduction because of usage of those units. Friends, what is happening in all these cases? All the examples that I gave you, the value of the asset gradually is going down. I am repeating, value of the asset is gradually going down. That is definite in all the examples. But in some cases, the value of asset was going down because of usage. In some cases, it could be because of just time, because of passage of time. Because of time, the worth of asset is going down. In some cases, the value of asset was going down because it was being used. Based on the number of units from oil well which were drawn out, the value of asset is going down. So like that, reasons could be many, but the reality is the worth of the asset is going down. Friends, that concept is what we call as depreciation. Depreciation means it is a permanent reduction. It is a permanent fall or a permanent reduction. Reduction in what? Reduction in the worth of the asset. Reduction in the worth of the asset. Why is there reduction in the worth of the asset? The reduction in the worth of the asset could happen because of usage of the asset or passage of time or because some number of units are extracted or explored, etc. Because of that also the worth of the asset can go down. So reasons can be many, but the reality, as I said, is worth of the asset is going down. Friends, that is what we mean by the concept of depreciation. Now comes the question. Why is it important to talk about depreciation in our accounting? The reason is this. When I purchase, say, raw material, or when I purchase some consumable items, okay, so all those things normally we charge off to P&L, we debit to P&L account, saying these are the expenditures which we incur during the period, because those expenditures generate benefit only for that one accounting period. Understand this point carefully. That expenditure is debited to P&L in that period because it generates benefit only once in that accounting period. So if I pay for any material, that material has gone into finished good and finished good is sold off. That material which I purchased, which got processed and which went into finished good I sell only once, right? I don't sell finished good 10 times. So I sell finished good, that specific finished good which is made, I sell it only once. So once I sell the finished good, that's all. I can't sell once to you, the same thing I can't sell to someone else, again I can't sell the same thing to someone else. Maybe I have to sell some other finished good to other person. So the main point here is the items which things like raw material, they may go and form part of finished good, and though that finished good when it is sold, there can be benefit that we get. But that benefit is one time. Please understand. What did I tell you just now? That benefit is one time. That benefit is one time means from that one sale, you will not get an ongoing benefit. You will get benefit only once from that particular asset. Okay. Now, if I purchase a car, I buy a car for my utility. I want to drive from my home to my office and then to say different places. So for that purpose I purchased a car. That car, will it give benefit only once? Is it only for one drive? No. Will it be only for one accounting period? No. Generally, car has utility over multiple accounting periods. Let us say 5 years. So car may have utility over 5 accounting periods. So this car which has utility over 5 accounting periods, can I debit that entire expenditure to one P&L account? No, I should not do that. Go back to matching concept of accounting. In matching concept, we say that when there are benefits, correspondingly they should be costs debited to that period's P&L account. Understand this carefully. In one period, you are recognizing benefits. In the same period, costs corresponding to such benefits should be debited to trading profit and loss account. That is what we mean by matching concept. When I say the car is important for me to run the business, but car is going to give me benefit over multiple accounting periods. So imagine in the P&L account, there will be credit to P&L account, benefit, I'm just saying benefit which is coming to us over multiple accounting periods, say over 5 years. Can I debit the entire car cost only in 1 year? No, you should not debit the entire car cost in 1 year because benefit from that is coming over 5 accounting periods. So cost also should be debited to P&L over 5 accounting periods. Please understand, as simple as this. If benefit is coming to you over 5 accounting periods, cost corresponding to that also should be debited over 5 accounting periods. That is what I mean by matching concept of accounting. So here what we do is we ascertain, hey, what is the life of car? Now, who can decide the life of car? We are saying for the purpose for which we want to use it, what is the estimated useful life? Okay, so even a car which is hardly in a capacity or hardly in a position to drive, maybe somebody just wants to keep it at their house as a vintage piece. It's just like, how old car, I bought it, this is my first car, I want to keep it. There will be some people like that also, right? So they may just have it as a collection. So that does not automatically mean that it is useful for everybody. That is why you should ask yourself, what is the estimated life for which this car will be useful for your purpose? If I say this car will be useful for my purpose for 5 years, okay, over 5 years I need to debit this cost to P&L, means say this is the total cost. I am saying small pieces every year I will charge off to P&L account. Gradually at the end of 5 years, you will have most of the value of the car already charged off to P&L account or already debited to P&L account. That is the logic. Okay. Now, let us just take one more example to understand in depth as to how the logic of depreciation accounting flows. Now, friends, when I purchase car, what is the journal entry I will write for purchase of car? Car is an asset, fixed asset. It's coming in. So fixed asset, car account debited to bank. We made that payment, say 5 lakhs, 5 lakhs. That is the journal entry what we passed. So 5 lakhs of money has gone out. Now, if this car is not fixed asset, if it is just an expenditure, what will I do if it is just an expenditure for that period, revenue expenditure for that period? What will I do? I will immediately write at the end of the accounting period, P&L account debited to fixed assets car account. I will write if that is a revenue item. But is it a revenue item? It is not a revenue item. What do you mean by revenue item? A revenue item generates benefit only for that accounting period. But is car a revenue item? No. If car is something which we expect will generate economic benefits to us, means benefits to us over multiple accounting periods means more than 1 year, then that expenditure is not revenue expenditure, it is a capital expenditure, right? So because it is a capital expenditure, simply I cannot say P&L account debited to fixed asset car account. No, that is a wrong entry. Then what should I do? If the entire expenditure is expected to generate benefit only for one period, like revenue expenditure, that journal entry was fine. P&L to fixed asset car entry was fine. But it is expected to generate benefit over multiple accounting periods, let us say 5 years. So then what we do is that 5 lakhs cost, we will write off to P&L only. We will write off to P&L, but not in 1 year. What we will do is, in the first year we will say, 1 year over, 1 year over. Okay. Then 1 year's portion out of 5 years, we will write off to P&L. 1 year's portion out of 5 years means for 5 years it is 5 lakhs. For 1 year how much? Like that we are trying to make a calculation and say it is 1 lakh. That 1 lakh portion we will write off to P&L account. So then what will happen? The fixed asset what we bought at 5 lakhs, out of that 1 lakh you will debit to P&L. Still 4 lakhs will remain as a fixed asset in the balance sheet. Then second year will be over. Once second year is over, maybe 1 more lakh we will write off to P&L. After that you will have 3 lakhs left in the fixed asset. Third year is over, 1 more lakh you will write off to P&L. Then you may have 2 more lakhs left out in the fixed asset. Like this gradually over a period of time. See, at the end of 5 years what will happen? The entire 5 lakhs probably would have been written off to P&L account. So basically the idea is, instead of debiting P&L account all at once, we should debit P&L account based on the period when we are getting benefit from that particular asset. If I am getting benefit only for 1 year, then the entire cost should be debited to P&L only in 1 year. If I am getting benefit over 5 years, correspondingly P&L should be debited over 5 years. Okay, right. Now you may ask me a question. Sir, at the end of 5 years, is it possible that the car is still saleable? Why not? Maybe at the end of 5 years, you just bought the car, you made an assessment, you went to some second-hand seller of cars, you understood that if you sell off this car at the end of 5 years, you will get about 1 lakh rupees. Okay, very good. So you paid 5 lakh rupees today, and at the end of 5 years, if you sell off the car, you will get 1 lakh rupees back. Means in 5 years time, 4 lakh rupees is the net cost of the car which you are effectively incurring. Yes or no? 4 lakhs is the cost of the car which you are effectively incurring. So 4 lakhs is the worth of car which you have to write off over 5 years time. Means every year, instead of writing off 1 lakh, now how much will you write off? You may write off 80,000 rupees, 80,000 rupees, like this. Every year you will write off 80,000 rupees. So out of 5 lakhs, if you write off depreciation of 4 lakhs, how much will you be left with at the end of 5 years? You will be left with 1 lakh rupee, right? So 1 lakh rupees, I can call it as salvage or estimated residual value. What do I call it? Salvage value or estimated residual value. This is the value that I am expecting from the asset at the end of its useful life. At the end of its useful life. At the end of its useful life means after that is it worthless? No, after that I don't need it. I'm repeating what I'm saying. After 5 years, I don't need it for my style and for my lifestyle. I don't want to use my car after 5 years. Say that is what I'm saying. Then after 5 years, it is not suitable for me. Maybe somebody who wants to buy it, maybe for them it is suitable. For me, it is not suitable. So estimated useful life for me, for that with respect to that car, if it is 5 years, and at the end of 5 years, if it is expected to realize 1 lakh rupees, then I'm saying 5 lakhs minus 1 lakh, 4 lakh rupees is what I will depreciate over 5 years time. So every year 80,000 will be debited to P&L account. Friends, I hope you understood that there is this amount called as salvage value or residual value, estimated residual value. When are you estimating this? At the time of acquiring the asset only you are estimating this. This is the value at what point? This is the value what the asset is expected to have, because we just bought the car. After 5 years we will actually sell it off, but we are expecting that it will have a value of 1 lakh rupees at the end of 5 years. So it is the expected residual value or salvage value. So it is our best estimate. What is it? It is our best estimate. Okay, very good. So without really telling you big terms, actually I introduced you to many aspects of depreciation with these examples. What all aspects did I introduce you to? 5 lakh rupees I said is the worth of car. That is called as capital cost of asset. What is it called? That is called as capital cost of asset. Okay. Then I said at the end of 5 years the car might be worth 1 lakh rupees. That is called as residual, estimated residual value or salvage value. Just now we spoke about this terminology. Then I spoke about life of car is 5 years. That is called as estimated useful life. What is it called? Estimated useful life. Then if that be the case, then you are writing off the asset over the estimated useful life as per some rate. Okay. So the rate at which you are writing it off, we will call it as depreciation rate. We will call it as depreciation rate. Now think about it. I want to write off 5 lakhs minus 1 lakh, 4 lakh rupees I want to write off over 5 years time. Please understand carefully. I want to write off 4 lakh rupees over 5 years time. Means what? 4 lakhs by 5, correct or not? 4 lakhs by 5. If I am following something called as straight line method, means equal depreciation method if I am following, then 4 lakhs by 5 is what I have to write. Then I will arrive at, oh, every year depreciation is 80,000 rupees. Every year depreciation amount, we call it as annual depreciation, is 80,000 rupees. Now listen carefully friends. 4 lakhs by 5 gave us 80,000 rupees. Can I write this as 4 lakhs into 1 by 5? Can I write it? Absolutely. 4 lakhs by 5 or 4 lakhs into 1 by 5 mean the same. 1 by 5, can I write it as 20%? Correct or not? Arey, how can I write like that? Arey, think about it here. 1 by 5, if I want to put it in decimal, what will it be? 0.2. Okay. 0.2, if I want to represent that as a percentage, I can say it is 20%. It is 0.2 for every 1. 0.2 for every 1 means for every 100 how much? For 100 it is 20%. So basically, based on all this discussion, logically without by-hearting, you understood, acha, depreciation rate also can be calculated. In our example, depreciation rate is 20% because it is straight line method we call it, or equal depreciation every year. So we arrived at something called as straight line method based depreciation rate, which is 1 by 5, into basically you are trying to put it as a percentage, which is 20%, which we call as depreciation rate. I hope you understood what we mean by depreciation rate. Now just now I told you that we are following a method, or I just followed a method called as straight line method. Straight line method means every year equal amount of depreciation will be debited to P&L account. Every year equal amount of depreciation will be debited to P&L account. Is this the only method? No, there are other methods also. So we have to choose a method what we want to follow for depreciation. That is the other one. So friends, that's all. You got familiar with different terminologies regarding depreciation. Now comes the question. From when should we start charging depreciation? It's an important point to think about, right? From when should we start charging depreciation? Friends, the principles of accounting tell us that we should start charging depreciation from the time the asset is capitalized. New terminology. From the time the asset is capitalized. When should we start charging depreciation? we should start charging depreciation from the point when the asset is capitalized. What is the meaning of asset being capitalized? When I say asset is capitalized, it means two conditions are met. Listen carefully. Risk and reward in the asset is transferred to us. Risk and reward in the asset is transferred to us. Plus, asset is ready for its intended use. There are two conditions. Risk and reward in the asset is transferred to us. Plus, the asset is ready for its intended use. If both these conditions are met, then we can capitalize the asset. Okay, let us go into detail. Risk and reward in the asset is transferred. What does it mean? Okay, friends, I want you to be honest about this discussion. When I give you some examples, you have to put yourself in that place and think honestly what comes to your mind. Okay, listen carefully. I went to a car showroom. I saw a car and I liked the car. I took that car and went for a test drive. Okay, I took that car and went for a test drive. Now, car is in my hand. Car is in my hand. Okay. Do I feel, looking at that steering wheel, do I feel that this is my car? Do I feel that it is my car? No, I don't feel that. Why do I not feel that? I know that I'm just driving this car. I have the car keys with me. I'm driving this car, but it is not mine. Why is it not mine? I never bought it. I never bought it. So, risk and reward in that asset has not been transferred to me. That is why, even though I have the car keys, I'm driving the car, still I don't feel it is my car because I haven't purchased that car. Okay, risk and reward in that asset is not transferred to me. Okay, keep it aside. Next example. If I actually paid money, purchased the car, I haven't taken delivery of car. I haven't taken delivery of car. I told the shopkeeper, the car vendor, I told that person, hey, I will come and take delivery of my car after my sister comes. So let her come, and in her presence I want to take delivery of my car. So I waited for 2 days to take delivery of my car. Okay, so I love my sister and that is why I want to wait for her before I take delivery of my car. Possible, quite possible. Now tell me, will I tell my friends that, hey, I bought a car? Will I tell them? Yes, I will tell them that I bought a car. And if they ask me, hey, where is your car? I tell, I kept it still in the showroom, but I bought a car. I will not say, just because I haven't taken delivery, I will not say, I will buy car after 2 days. No, maybe I already settled the account, everything. So, even though delivery is not taken, still it is my car. Okay. So, friends, like this, there are different ways in which you have to understand risk and reward. Risk and reward means the benefit from that car is mine. Any risk on that car is mine. For example, once I buy the car, tomorrow I realize that rates of car have gone up by 20%. In the budget, rates of cars have gone up by 20%. There is a budget announcement like that. Will I have to pay extra 20%? No, I already bought the car. I don't have to pay extra 20%. So, I am benefited because I already purchased the car. Had I not bought the car, maybe I would have had to pay extra 20%. You understand what I am saying? Similarly, after I bought the car, say I bought a diesel car. Suddenly there is an announcement that all diesel cars are banned for some reason. Okay, so there is an announcement, all diesel cars are banned. Now I already bought the car. Even if I have not taken delivery, if I already purchased the car, if there is an announcement that diesel cars are banned, I worry about it. Why do I worry about it? That car is mine now. I know that car is mine. Friends, that is what I mean by transfer of risk and reward. Transfer of risk and reward. Transfer of risk and reward incidental to the ownership of car. What is this? Transfer of risk and reward incidental to the ownership of the car. So, whatever benefits or problems the owner of car will have, if I have those problems, then I can say risk and reward in the car is transferred to me. The second point is, okay, I bought the car and it should be ready for its intended use. It should be ready for its intended use means what? Friends, I bought the car. Say, for what purpose did I buy the car? I bought this car for racing. So, I need to change the wheels, I need to get different kind of wheels, I need to change the body of car. Like this, there are a lot of stuff, a lot of things I need to change in the car for the car to be racing ready. Now, I just bought the regular car. It has to go through a lot of modifications for it to be ready for its intended purpose. I am repeating, car is ready, but car is not ready for the intended purpose. The intended purpose is racing. If intended purpose is racing, there are some more modifications which have to be done. Without those modifications, car I cannot say is ready for its intended purpose. So here what I will say is, hey, car per se is ready, but car is not ready for its intended use. Only when risk and reward is transferred plus the car is ready for its intended use. If both these conditions are met, then we can say I can capitalize the asset. Then I can capitalize the asset. Capitalize the asset means that asset, whatever purchase we are talking about, it can be recognized as a fixed asset. In other words, only when it is ready for its intended use, the intended benefit from the car can be achieved. Correct or not? See, only when it is ready for its intended use, the intended benefit from the car can be achieved. So, if it is not even ready for its intended use, it is not ready for its intended benefits, to generate its intended benefits. So, whenever the asset is ready for its intended use, plus risk and reward should have been transferred. If both the conditions are met, then we can capitalize the asset. Once we capitalize the asset, from that day, depreciation on that asset can start, because depreciation is a periodic cost. Depreciation is a periodic cost. What do you mean by periodic cost? It is like rent. When I say rent, if I take a property on rent, now there will be a date from which that rent agreement will start. From that day, even if say for 1 month I am traveling, I did not use the house, still should I pay rent or not? Naturally, I should pay rent even if I am traveling. Traveling or staying in the house is my prerogative, but I should still pay rent because I committed to that cost. That is a fixed cost. That is a committed cost. Similarly, this depreciation is also a fixed cost, I would call it. It is basically a periodic cost. Oh, 1 year is over. For 1 year, depreciation has to be charged. Okay, like that we have to provide for depreciation. Of course, if I purchase the asset on the first day of the year and asset is ready for its intended use on the first day of the year, so risk and reward transferred plus asset is ready for its intended use on the first day of the year, then for what period will I provide depreciation? Full year I will provide depreciation. Okay. Then if I purchase the asset on the last day of the year, then is asset ready for its intended use? Yes. Is the asset risk and reward transferred to us? Yes, transferred. Both conditions are met. I can capitalize it. But in this year, did I really use that asset, or was it ready for its intended use? No, it was ready only on the last day. So obviously you wouldn't have used the asset in this year. So you will not provide depreciation in this year. You will start providing depreciation from the beginning of next year. On the other hand, say somewhere around mid of the year you purchase the asset and it got ready for its intended use. Then for half year only you will provide for depreciation. Means only for that period you will provide depreciation. After 9 months I purchase the asset, then only for 3 months I will provide depreciation. After 3 months from the beginning of year I purchase the asset, for 9 months I will provide depreciation. Friends, I hope you understood. So whatever is the depreciation amount you get, it is to be made pro rata for the period for which it was used in the business, or basically it was ready for its intended use in the business. Okay, so lot of things regarding depreciation we just hang off. Now let us start taking small topics and we'll go into in-depth understanding of depreciation now. So from all this discussion, what can we infer? What do we depreciate? We depreciate a depreciable fixed asset. Acha, big word. Depreciable fixed asset. Let us analyze each component separately. What is an asset? First you should know. Then you should know what a fixed asset is. Then we will talk about what a depreciable fixed asset is. Okay, right. What is an asset? An asset is a resource. An asset is a resource owned or controlled by the entity. An asset is a resource owned or controlled by the entity which has the capability to generate future economic benefits. Right. And most importantly, the enterprise should have a right to enjoy those future economic benefits. Now, let us understand what we mean by asset in much greater depth. An asset is a resource. Resource means it should be something valuable. Owned or controlled by the entity. Owned or controlled means basically by owning or controlling, the benefits which come from that asset should come to us. So whatever that asset can generate as benefits, we should be the beneficiaries of that. Whatever good can come out of that, we should be the ones to enjoy that particular benefit, right? So that is what I mean by an asset should be a resource which should have the capability to generate future economic benefits, and we as an entity should have right to enjoy those future economic benefits. Okay, that is what I mean by an asset. Now, what is a fixed asset? See, when I say an asset, cash is an asset, bank balance is an asset, inventory is an asset, land is an asset, car, unless we are a car seller, car dealer, car is an asset. Whatever the purpose of car be, car is an asset. Then investments are an asset. Like this, there can machinery, furniture, plant, whatever you can think of, all those items are assets only, no? So all these are assets. But now, when I talk about fixed asset, what is the meaning of fixed asset? Fixed asset will have all the characteristics of assets plus something else. Fixed asset should have all the characteristics of assets plus something else. What is that something else? It should primarily be held with an intention to use in the business, not with an intention to sell in the ordinary course of business. That is the first point. It should primarily be held with an intention to use in the business. Means I am having car and my intention of buying car should not be to sell the car. I am not a car dealer. Okay, my intention of buying car should not be to sell car. I shouldn't be a car dealer. Then the intention should be to use it in my business. My intention should not be to primarily sell it. My intention should be to use it in the business. Now you may ask me, sir, after 5 years you will sell your car. I selling the car after 5 years does not mean that my intention of buying car is to sell car. See, if my intention of buying car itself is to sell car, why will I wait for 5 years? Think about it. I will not wait for 5 years. If my intention of buying car is to sell car, I will buy car today, in next 1 week I will sell off the car. No, that should not be my intention. My intention of buying the asset should be, or constructing the asset should be to use it in my business, and by using the asset in the business, future economic benefits should be generated. So future economic benefits should be generated by using the asset in our business. And the second thing is, if I call something as a fixed asset, it should have the capability to generate future economic benefits over multiple accounting periods. It should have the capability to generate future economic benefits over multiple accounting periods. Meaning, it should not be something which has the capability to generate benefit only once, only in 1 year. No, it should not be the case. It should have the capability to generate future economic benefits over multiple accounting periods. In our example, car, we said, has the capability to generate benefit over 5 years. That is when I said car is my fixed asset. Okay. So these are the special points which you need to add to make an asset into a fixed asset. So asset plus these points will make it a fixed asset. Okay, fine. Now, what are the examples for fixed asset? Land, fixed asset, because one, it's an asset, plus if my intention, of course, if my intention is to use the land for my business, maybe I want to construct a factory on that, I want to keep a godown, I want to maintain a godown there, or whatever it be, so I want to use it for my business, then land is my fixed asset. Then this asset, plant and machinery, could be my fixed asset. Furniture could be my fixed asset. Computers could be my fixed asset. Then we may have vehicles which could be fixed assets. Like this, assets which have the capability to generate benefit over multiple accounting periods, plus they are held with an intention to use but not with an intention to sell in the ordinary course of business. So if the assets meet these conditions, then we can call them as fixed assets. Now, what is the other word which we are adding to this now? Depreciable fixed assets. All the fixed assets can be divided into two: depreciable fixed assets, non-depreciable fixed assets. Let us first talk about non-depreciable fixed assets. Everything else will be considered under depreciable fixed assets. Now friends, if I purchase land, will life of land be limited to 1 year, 2 years, 3 years or 4 years? Will generally will the life of land be limited? No. After you complete using the asset, say you constructed a factory, Factory life may be 50 years, factory life may be 20 years, whatever. After that life, you can clear up the factory. There can be residential apartment which can come up there. Who can prevent that? After that, you may clear it up and maybe it can be a cricket ground. Who can prevent that? So, like that, once the specific asset what you are constructing on it, after its life is exhausted, the asset can be put to further use. So, generally, life of land is considered to be infinite, or maybe if you want to be technically correct, it is the life of earth, right? So you can say it might be the life of earth, because as long as the earth survives, maybe the land piece also should survive. So something like this, but definitely it is not 5, 6, 7, 10 kind of years. So it must be millions of years. So from that point of view, we can say that generally land is a non-depreciable fixed asset, meaning generally the life of land does not come down because it has infinite life. It has a significantly long life. So, life of land does not have any specific determinable number. That is why we can simply say land is a non-depreciable fixed asset. Now, other than land, if you take examples like building, is building depreciable? If you look at an old building, you can clearly see, ये building तो गिर जाएगा कभी. So you feel that. Why do you feel that? You feel that because that building has shown some cracks. That building looks old. That building is showing some signs that its life is wearing off, right? Similarly, plant and machinery, similarly vehicles, similarly computers. So these are fixed assets, but they may be tangible and they may be depreciable fixed assets. These fixed assets, what I spoke about just now, are depreciable fixed assets. So, their life gradually comes down and finally at some point of time, it will become worthless. That is why we call them as depreciable fixed assets. So, friends, the main point is depreciation concept should be applied only for these depreciable fixed assets which have fixed determinable life. Fine. So, now we understand what kind of assets need to be depreciated. Now, why do we have to do depreciation at all? So, these depreciable assets, as I said, gradually, permanently lose their value. Okay. So, these assets gradually, permanently lose their value. So, something which is worth 5 lakh rupees over time may come down to 1 lakh rupees. So, this losing value will be because of a few reasons. The first one could be merely use. You are using the asset so much that the value of asset is going down. Second could be just efflux or passage of time. Passage of time is a simple word to understand or a phrase to understand. Efflux of time is an accounting terminology. Efflux of time also means the same thing. So, as the time goes on, the worth of the asset goes down. That is what I mean by efflux of time. Then, there might be obsolescence through technology or market changes. What is the meaning of obsolescence? Basically, the asset becoming outdated. The asset, if it becomes outdated, it becomes irrelevant, it becomes worthless over time, then also you need to provide depreciation. Then, this asset's value may gradually go down because of something like depletion. What is depletion? I gave you the example of that mine, that petrol mine where petrol tank or well, whatever you want to call it, where as you extract petroleum from it, the reserve of petroleum that is available in it will go down gradually. Okay. So, gradually as you complete extracting that, well, you might be left one day with an empty well. So, that is what I mean by depletion. Depletion is also something like depreciation only, but you use the word depletion in relation to natural resources. So, these are some of the reasons why the asset's value goes down gradually. Now, let us look at some small definitions what we have as per Companies Act 2013. Depreciation is the systematic allocation of depreciable amount of an asset over its useful life. The depreciable amount of an asset is the cost of an asset or other amount substituted for cost less its residual value. The useful life of an asset is the period over which an asset is expected to be available for use by an entity or the number of production or similar units expected to be obtained from the asset by the entity. So, from these definitions, what we have as per Companies Act, what is depreciable amount? In that example of car, I said 5 lakhs cost of asset minus 1 lakh of residual value. 5 lakhs minus 1 lakh, 4 lakhs is what we said we are going to depreciate. So, 4 lakhs we call as depreciable amount. 4 lakhs we call as depreciable amount. Now, this depreciable amount will be depreciated or will be written off over what period? It will be written off over the estimated useful life of the asset. What do you mean by estimated useful life of asset? In our example, it was 5 years, the period for which we intend to use the asset in our business, or the period for which we expect the asset to be useful to us in our business. That is what we mean by estimated useful life. So, over that period, we will have to write off this asset. Then, the other point we spoke about was, we said, hey, sometimes we may write it off over certain period of time. Sometimes we realize totally 10,000 units or 10,000 metric tons of oil can be extracted from that well, and I already extracted 7,000 metric tons of oil from that well. Then what does it mean? 70% of the depreciable amount of the asset is gone. 70% of the depreciable amount of asset is gone. So, you may consider the depreciation based on time, that is number of years, or number of units produced or extracted, as we may call them. So, based on that also you can provide for depreciation. For example, if I say there is a machine for stitching clothes and that machine can stitch say 10,000 shirts. Now, that machine already stitched 7,000 shirts. What does it mean? After 3,000 shirts, the machine will be worthless. So, you may provide depreciation based on the number of units produced by that machine also. So, you may say 7,000 out of 10,000 worth of asset is gone. Means 70% of the asset is already depreciated by now. Like that you can consider depreciation concept. Now friends, there will be some interesting discussions we will have regarding depreciation based on some unique circumstances. Let us say, car may have life of 5 years. But when you take tires, right? So these tires generally have life of about 50,000 kilometers. After that, you have to replace these tires. So most of the vehicles run for about 50,000 kilometers in about 1 to 1.5 years. So in 1 to 1.5 years or maximum 2 years, you need to replace those tires. Okay. Now, if I replace tires, listen carefully to my question. If I replace tires and I spend 50,000 rupees for new tires, should that cost be considered as a separate asset, or should I club it with the car and should I provide depreciation over 5 years the way I provide depreciation for car? Is the specific point what we are trying to examine here. I am repeating, car has life of 5 years. Tires have life of say only 2 years. In such a case, should we treat tires as a separate asset, or should we treat tires also as a part of car, is what we are trying to evaluate. Friends, it could be car, it could be aircraft, it could be something else, but the principle what we are trying to understand here is, should assets be combined to provide depreciation, or should assets be separated and individual components be provided, should we provide depreciation for individual components? The answer is very simple. We have the answer in the accounting standard. So what it says is, if the component is significant, in relation to the overall cost of asset, say for a moment, the value of tires is 10% of the value of car, 10% is, I am considering 10% to be significant, okay. So 10% is the value of tires compared to the value of car. So I feel value of tires is significant. Second question, the component should have life different from the life of the asset overall. So here, component called tires have life of 2 years only, but asset has life of 5 years. So component's life is significantly different from the life of the asset. So in such cases, you can recognize components separately as an asset. You can recognize components separately as an asset. So maybe tires alone will be one asset and rest of the car could be some other asset. Okay, so could be another asset. So like that I can split the asset and provide depreciation. Friends, are you clear about this point? So then I may provide depreciation on tires over 2 years and I may provide depreciation on the balance 4.5 lakhs of asset over 5 years time. Okay, so like that we can split and consider depreciation on assets provided these two conditions are met. Once again, what are the two conditions? The components cost should be significant compared to the overall cost of asset and the component's life should be significantly different from the life of the asset overall. So if both these conditions are met, then I can treat that component as a separate asset and provide depreciation on that separate portion of asset. Now, what is the objective of providing this depreciation? Friends, based on all this discussion, we already understood that if we want to honor the matching concept of accounting, we need to provide for depreciation. What do we mean by matching concept of accounting? We want to match the benefits and costs, right? So we want to match benefits and costs. If we are getting benefit over 5 accounting periods, cost corresponding to that should be debited to P&L over those 5 accounting periods. We already spoke about this point, meaning we want to understand the correct position of profitability. So for that purpose, we need to debit depreciation, otherwise the profitability picture will be affected. Now, what exactly is happening? Say we bought the asset at 5 lakhs. At the end of 5 years, we are going to get a value of about 1 lakh. So, depreciable value of asset is 4 lakhs and estimated useful life of the asset is 5 years. So, 4 lakhs over 5 years, about on straight line basis, about 80,000 rupees per year we are providing depreciation. Okay. Now, first year, I purchase the asset worth 5 lakhs. At the end of first year, what will I do? I will reduce 80,000 from the asset and correspondingly charge it off to P&L as depreciation. So, when I charge it off to P&L as depreciation, two things are happening here. Asset value from 5 lakhs is going down to 4.2 lakhs, right? Second thing, to 80,000 rupees is getting debited to P&L account. So, the asset is reflecting true and fair view because the asset's worth has gone down and the reduced worth of asset is what is shown as per the balance sheet after depreciation. Then come to P&L. When you say you debited 80,000 to P&L account, the cost of production or the cost of selling, the overall costs, let me simply say costs, it is getting debited to P&L means that 80,000 of cost is getting considered. So, we are able to ascertain the true costs for the company. True costs for the company. Then, when I debit that 80,000 to P&L, the profitability correspondingly will come down. Profitability, when it is coming down, is it wrongly coming down or is it correctly coming down? It is correctly coming down, meaning the profitability should be reduced and it is actually reduced. Why should profitability be reduced? It should be reduced because when you are honoring the matching concept, that entire expenditure in one shot you are not debiting to P&L because the benefit of that is coming over multiple accounting periods. Because the benefit is coming over multiple accounting periods, you are charging off to P&L over multiple accounting periods, thereby reducing the profit to that extent. Okay, so profit position also will be reflected appropriately. Then, what exactly will happen when the profit position is reduced? Now you see friends, say the profit before you reduced depreciation was some 8 lakh rupees in the company. Now you debited 80,000 in the form of depreciation. So 8 lakh profit after reducing 80,000 rupees will be 7.2 lakhs. So the revised profitability is 7.2 lakhs. So if anybody asks you, hey, what is your profit now? You will not tell 8 lakhs, you will tell 7.2 lakhs. But tell me one thing, are you paying this 80,000 out of your pocket to anybody today? It is not like a rent expenditure which you are paying to anybody today. But when people are asking you for your profits, you are telling them that my profit is only 7.2 lakhs, it is not 8 lakhs. Hey, why are you reducing that 80,000 rupees? You are reducing that 80,000 rupees because of depreciation. Thereby, you are not reflecting the profit at 8 lakhs, you are reflecting the profit at 7.2 lakhs. You know what is happening silently behind the screen? There is an amount of 80,000. Even though you did not pay out to people, you are not showing it as profit. Now, thereby, tomorrow, to our shareholders, to our owners, if I want to pay some profits, hey, I got profit, come on, take this profit, I want to give it away to people as profit, I want to distribute that profit. When I want to distribute profit, will I distribute 8 lakhs or will I distribute 7.2 lakhs? I will distribute maximum only 7.2 lakhs. I will not distribute 8 lakhs because I don't feel that I made a profit of 8 lakhs. I feel that I made a profit of only 7.2 lakhs. You know what? Thereby, that much money, 80,000 rupees money, has not been distributed to people as dividend. What will happen if it is not distributed as dividend? We earned it and it will remain in business. We earned it and it will remain in business. In the future, if I want to replace the asset, I will have resources. If I want to replace the asset, I will have resources. Okay. So these are the purposes for which we love this concept of depreciation. Alright, so now we understood the reason why we require depreciation as a concept. Now, let's actually get into the calculations of depreciation. We'll start solving problems, all of that. So now one other important concept we need to be super thorough with is what is the amount we are going to depreciate. I said we are going to depreciate the depreciable amount. Okay, depreciable amount means what? The acquisition cost, or I will call it as capital cost of asset minus estimated realizable value. Capital cost of asset minus estimated realizable value. Now, what do I mean by capital cost of asset? The value at which the asset has been capitalized in the books of account is what I call as capital cost of asset. Achha? What all elements go into it? Now listen carefully, friends. I bought a car. Okay. I paid to the car dealer 4,70,000 rupees. Fine. Straight away, that purchase price of 4,70,000 will be considered. Then I paid 10,000 rupees towards life tax on the car or road tax on the car, and without that amount I will not get the car delivery. Okay, 10,000 rupees is mandatory payment, 10,000 rupees will be added. So add the 10,000 rupees. So it will become 4,80,000. Then compulsorily I have to get the registration done. Registration will cost me 20,000 rupees. Without that I can't use the car freely, so I have to get registration done. 20,000 rupees I have to pay for registration. Add 20,000 rupees of registration charges. So I added that 20,000 rupees of registration, that became 5 lakh rupees. Like this, all the expenditures which are necessary to bring the asset into the present condition, location, which you want to use, the way in which you want to use the asset. So for example, I want to use this asset in Andaman and Nicobars. Now the car was purchased in Delhi, but I have to move this car from Delhi to Andaman Nicobars. Now if I have to move it to Andaman, then the transportation cost from Delhi to Andaman has to be included. Why? The purpose of my purchasing this car is to use it in Andamans. So maybe 25,000 rupees I am going to incur for the transportation. That 25,000 rupees of transportation, whatever we incur, should be added to the cost of car. Why? Because I want to use the car in Andaman. So that is my requirement. So that is why I have to include the transportation cost till Andaman into capital cost of car. Similarly, I want to use this car in Andaman for racing purpose. I don't know where I will do racing, but I want to do racing. So I want to do racing. So for that purpose, I am going to spend some money to remove these irregular tires, bring fancy tires in. Then I'm going to change the exteriors. I'm going to change the look and feel of the car. Now that's my plan. I want to use it for racing, and these are all the expenditures whatever I incur. Say that remodeling of car is going to cost me 75,000 rupees. Sure, that 75,000 rupees, whatever I need to incur to remodel the car, should be added to the cost of car, because I want to use the car. My purpose of acquiring the car is to use the car in Andaman for racing purpose. So, if that purpose is specified, then the costs which we need to incur to get the asset to that present location, in our example Andaman, present condition is racing, sports car. So, all those costs will be added to the cost of asset. Will be added to the cost of asset means they will be capitalized as a part of cost of asset. So friends, purchase price, installation amount, then any transportation amount, then any taxes, duties which are non-refundable. Okay, so here if I pay road tax, it doesn't come back to me. So it's a road tax, I pay it and that's all. So all these non-refundable taxes, duties, then any transportation cost what we are incurring for that asset, then maybe somebody we are sending for doing this inspection. We want a sports car, so we want to be sure that the car is ready. So maybe we are spending 3000 rupees to send a person and do the inspection. That cost also will form part of asset. Then the remodeling cost, whatever you are incurring to get the asset into present form, location, condition which you want it in and the way you want it. All those costs will form part of capital cost of asset. Is it clear, friends? All these costs will form part of capital cost of asset. Right. Now, from that capital cost of asset, so call it 6 lakhs, you have to subtract whatever is the residual value. If residual value, see, I am today standing at a point where I just bought the car. Now, the car's residual value means at the end of its estimated useful life, what value is this car going to fetch? So, standing here, I need to expect क्या हो सकता है इसका value at the end of 5 years. I have to make the best guess of the value of the car at the end of the useful life. So, it could be 1 lakh, it could be 2 lakhs, whatever. So, I need to subtract that and then arrive at something called as depreciable amount of the asset. Great. Now, let us move to the next aspect. I was just telling you a few times this terminology called straight line basis or equal amount over every year basis. Now, there are 3 popular methods which we use for depreciation. What are the 3 methods? The first one is called as straight line method or straight line basis for depreciation. That is the first one. The second one is called as written down value method for depreciation. We will understand everything with examples, okay? Written down value method for depreciation. And the third one is units of production based depreciation. These are the 3 methods which are popularly used. Besides these, there are some smaller subvariants like sum of years of digits method, annuity method, etc. But these are the generally used, popularly used methods for depreciation. Let us now talk about the first method, which is called as straight line method for depreciation. What is the meaning of straight line method? Now, concentrate carefully. If I talk about straight line method for depreciation, every year, equal amount of depreciation should be charged on that asset. So, simple. Imagine the entire cost, capital cost of asset is a huge stick, okay, something like a sugarcane stick. Then, whatever is the residual value, estimated residual value, that first let us remove, because that much value we don't have to depreciate because we are going to get that back at the time of selling that asset at the end of useful life. So, we will remove that portion, okay. I am repeating, we will remove the residual value of the asset, okay. Now, you are left with the balance portion of asset. That balance portion of asset, you should ask yourself, hey, over how many years should I depreciate this? 5 years? Then make it into 5 equal parts. Make it into small pieces, 5 equal pieces. If I say, oh, it is going to be depreciated over 10 years, make it into 10 equal parts. 3 years, make it into 3 equal parts. Like that, whatever is the depreciable amount of asset, that will be split over the number of years for which we plan to depreciate the asset in equal manner. That method of providing depreciation is called as straight line basis for depreciation. Now, what will happen in the straight line basis for depreciation? Say, I purchase the car at 5 lakhs estimated residual value is 1 lakh. So 4 lakhs is what is left out. Now 4 lakhs, I should ask the question, this depreciable amount of asset, that is 4 lakhs, should be depreciated over what life, over how many years? If the answer is 5 years, then this 4 lakhs should be split into 5 equal parts. So when I split into 5 equal parts, each part will be 80,000. So at the end of first year, 80,000 of depreciation will be reduced. At the end of second year, 80 more thousand will be reduced. At the end of third year, 80,000 again. Like this, every year 80,000, 80,000, 80,000, like this, we will provide depreciation. Now tell me, there is the asset, asset's worth is 5 lakhs. Now, first year, 5 lakhs is the worth of asset, we reduced 80,000, it comes down to 4.2 lakhs. Then, second year, 80,000 reduced again, 80,000 for second year if you reduce, it comes down to 4.2 lakhs minus 80,000, it comes down to 3.4 lakhs. Then, third year, from 3.4 lakhs, it will come down to 2.6 lakhs. Fourth year, from 2.6 lakhs, it will come down to 1.8 lakhs. And in the fifth year, after you provide for 80,000, 80,000 is gone, so 1.8 lakhs minus 80,000, it comes down to 1 lakh. Now, 5 years over, the asset value came down to 1 lakh. So, you wanted to bring the asset value down to 1 lakh, right? So, equally you wrote off this asset and brought it down to 1 lakh. So, friends, that 1 lakh is the residual value. So, equally every year you were provided for depreciation. This is called as straight line method for depreciation. So, friends, if you have to really look at it as a formula, which I don't like anyway, so I always believe in learning concepts as logically as possible. But if you just have to see a formula, what is the formula for depreciation? How did we arrive at 80,000? Very simple. Cost of asset 5 lakhs minus salvage value or scrap value or residual value. All these are synonyms, okay? So salvage, scrap, residual value, that is 1 lakh divided by number of years of life of asset. Estimated useful life of asset you can call it, or number of years of life of asset. So basically the number of years which are still left. So in our example 5 years. So like that you arrived at the amount which is 80,000 rupees. Now let us calculate something called as straight line depreciation rate. How do we calculate that? Simple. You have annual depreciation amount. What is annual depreciation amount in our example? It is 80,000 divided by the cost of asset. What is the cost of asset? 5 lakhs is the cost of asset, right? Into 100. That is what will give you the depreciation rate. So friends, calculate how much that comes to. 80,000 by 5 lakhs into 100. Roughly it comes to around 16%. So 16% is the rate of depreciation under straight line method. Now friends, as I told you already, if I purchase the asset on the first day of the year itself, then for the full year depreciation has to be considered. So full year means 80,000 in our example, depreciation will be considered. What will happen if I purchase the asset after 3 months from the beginning of year? After 3 months I purchased, means what is the balance period? 9 months, right? So 9 months depreciation should be considered, not 12 months depreciation. So then for 12 months if it is 80,000, for 9 months how much? 60,000. So 60,000 will be the depreciation for this year. From next year onwards it will be 80,000, right? Now look at another scenario. I purchase the asset exactly after 6 months. If I purchase it after 6 months, then the depreciation should be calculated only for the balance 6 months. So the depreciation will not be 80,000, depreciation will only be 40,000. Similarly, if I purchase the asset after 9 months, then depreciation should be considered only for the balance 3 months. So balance 3 months means only 20,000 in the current year. From next year onwards, it will be 80,000, right? So like this, friends, please understand, depreciation, whatever we are calculating as an annual depreciation amount, that should be adjusted for the period, particularly in the first year I am talking about. In the first year, based on the date of purchase of asset, date of acquisition of asset, you have to suitably decide the period for which depreciation should be charged in the first year. After that, of course, from second year, it will be full year depreciation. And of course, in the last year, it will only be for the balance period, right? That's all. Now friends, when I purchase an asset, there will be depreciation. But when I'm actually using the asset, there will also be some maintenance cost for that asset, right? So maintenance means what? I bought a car. Initially, first 1-2 years, maybe I'll have very few repairs. But as the car starts getting old, the repairs cost will go up. Practical, right? So if I talk about straight line method, what we are assuming is depreciation every year, constant, 80,000, 80,000, 80,000. But if I look at the expenditure towards maintenance, initially it will be low, slowly the maintenance cost on that asset will go up naturally. Now, friends, the point what straight line method does not do is, if I consider the amount of depreciation plus the maintenance, then I find that initially the cost which is getting debited to P&L is less, but gradually the cost which is getting debited to P&L is increasing, because while the depreciation amount is same, the component of maintenance cost is going up. Because of that, the amount of cost which is getting debited to P&L over a period of time will go up. That is one thing that you notice with respect to straight line method. To address this problem, we came up with the next method, which is called as written down value method or diminishing balance method. What is it called? Written down value method or diminishing balance method. Very simple. Think about it. Now, consider the cost of asset to be 5 lakhs. On 5 lakhs, say depreciation is 20%. Written down value method, depreciation is 20%. If it is 20%, in first year, what will you do? 20% of 5 lakhs. 20% of 5 lakhs, which will be 1 lakh rupees. So 1 lakh rupees of depreciation you will consider for the first year. Straightforward, right? Now, from 5 lakhs, if you subtract 1 lakh rupees, what is the revised value? 4 lakhs. For second year, you will apply 20% not on 5 lakhs. You will apply 20% on 4 lakhs under written down value method. So if I apply 20% on 4 lakhs, it will come to about 80,000 rupees. So 80,000 rupees will be the second year's depreciation. Okay. So now just understand. So first year 1 lakh depreciation. Second year 80,000. Like this, gradually year on year depreciation amount will come down. Initially depreciation is more, but gradually depreciation amount will come down. On the other hand, what will happen with respect to maintenance? Maintenance initially might be low, but gradually maintenance will go up. So if I look at it visually, depreciation initially is more, later years it is less. Maintenance initially is low, later years it is more. So if I take the total of depreciation and maintenance, maybe the total of depreciation and maintenance, which ultimately will get debited to P&L, maybe that is more or less comparable year on year. So you see what I'm talking about? So they are getting offset in one sense. So the total, if I look at, total might still be more reasonable or more equal than straight line method, is the assumption what we have under written down value method. So under written down value, what is the important thing you need to bear in mind? Straight line rate you are applying always on the original cost of asset, but written down value you will apply on the cost of asset minus depreciation amount which is provided till now. So in the first year, if I am applying, obviously I am applying on 5 lakhs, 20% I am applying on 5 lakhs. Second year, if I am applying 20%, I am applying not on 5 lakhs, I am applying on 5 lakhs minus 1 lakh of depreciation of current first year. So you are saying the second year depreciation is 20% of 4 lakhs, which is 80,000. So what will happen to third year? Third year you will say, hey, from 4 lakhs, 80,000 gone. So it is only 3,20,000. On 3,20,000, you will end up applying 20%, and so on. This continues. Like this, we will apply the depreciation. Now, how do you arrive at this rate of depreciation under written down value method? For rate, the way you arrive at it is 1 minus nth root of residual value by cost of asset into 100. Now, we will apply this into problems and understand more carefully. Nth root, when I say n, is the period. So if it is 2 years life, square root basically. If it is 5 years life, fifth root of the residual value divided by the cost of asset into 100 is what we are calculating. We will apply this into problems and then you will become more comfortable with this.